All right, welcome to The Explainer. Today, we're going to pull back the curtain on how the wealthy can legally pay little to no tax. Now, this isn't about some sneaky illegal stuff. It's about a playbook, a system, based on our source material that really anyone can learn. So let's dive in and break down the rules of the game.
Okay, so the whole idea, the entire foundation of this system, it all comes down to one massive shift in how you think. It's about seeing the tax code not as this big, scary wall you have to climb, but as a map of incentives that the government actually wants you to follow. So, here's how we're going to break it all down in this explainer. We'll start with that foundational mindset. Then we'll build the legal architecture, get into the engine that makes it all run, figure out how to fuel it with tax-free cash, and finally, see how this whole thing is built to last for generations. Pretty cool, huh?
All right, let's jump right into Section 1, the code. You know, before we even talk about LLCs or fancy trusts, it all starts right here, with a complete shift in how you look at taxes. It's about learning to read the tax code not as a problem, but as a set of instructions. A guide, really.
So here's the big difference, right? According to folks like Robert Kiyosaki in the source material, it's all about how you see it. For most of us, taxes feel like punishment, maybe even theft. It's just another bill you dread paying. But the wealthy, they're taught to see it completely differently. They see it as a set of directions, a roadmap full of incentives that the government is literally handing them. And that's the absolute key takeaway here. The tax code isn't just some big bill you get. It's a list of rewards. The government basically says, hey, if you do what we want you to do, like create jobs, build housing, invest in clean energy, we'll give you huge tax breaks. The system is literally set up to reward the people who build and invest. Okay, so this probably has you thinking, right? It raises a huge question. If the tax code is filled with all these rewards and incentives, why does it feel like I'm getting punished every single April? Well, the source material points to one simple answer. It all depends on the kind of income you earn. See, wages, the money you get from a W-2 job, that's the most heavily taxed income there is. It's super easy for the government to track, and let's be honest, there are hardly any deductions for employees. The wealthy, they play a different game. They focus on creating different kinds of income that the tax code treats, well, a lot more nicely. Okay, so that brings us to Section 2, the architecture. Once you've got that mindset shift down, the next piece of the puzzle is building the right legal structure. This is where you build your own financial fortress, and it's all built on one simple, powerful idea. Control everything, but own nothing. Yeah, that's the mantra right there. The whole goal is to create a separation, a firewall, between you personally and your assets. And how do you do that? You use legal entities, things like LLCs and trusts. Think of them like little legal firewalls. If one of your businesses gets sued or one part of your financial world gets into trouble, the rest of your stuff is safe and sound, protected behind that wall. Now, a lot of people get these two mixed up, but they have totally different jobs. It's super important to understand this. So on one side, you've got the living trust. Think of that as the big container, the blueprint for everything. It's passive. It just holds things and decides who ultimately owns them. And on the other side, you've got the LLC or the corporation. That's the engine. That's the active part that goes out and does business, makes money, and also, importantly, takes on all the risk. And this slide lays out that chain of entities just perfectly. It's like a multi-layered defense system. So at the very top, you have your living trust. It's the ultimate owner, holding everything for your legacy. That trust then owns a holding LLC, which is kind of like the parent company. And then that holding LLC owns individual business LLCs, each holding only one asset. Now, why do they do that? It's all about containment. If someone sues you over one property, they can't touch any of the others. Brilliant, right? All right, on to Section 3, the engine. So we've got the mindset, we've got the legal architecture built. Now, how do we actually make this thing run? Well, this is where the real magic happens. We're talking about creating paper losses that can completely wipe out your taxable income even while your bank account is getting bigger. Yeah, you heard that right. And the magic word that makes it all possible is depreciation. This is hands down one of the biggest, most powerful tax incentives the government gives investors. Basically, the government lets you take a huge deduction for the so-called wear and tear on an asset, like an apartment building. But here's the kicker. It's a non-cash expense. You don't actually spend any money, but you still get to write it off on your taxes. It's purely a paper expense. This simple example from the source material shows exactly how it works. It's pretty amazing. So look at this. You bring in $200,000 in rental income. That's real cash in your pocket, right? But then you have a depreciation deduction of $220,000. Remember, that's just a paper expense. So what's the bottom line for the IRS? You have a taxable loss of $20,000. You put 200 grand in the bank, but on paper you lost money. And what do you pay in taxes on a loss? You got it, 0.
Okay, so you're bringing in cash, but you're reporting losses to the IRS. So how do you actually get your hands on large chunks of that wealth to live on or reinvest without finally getting hit with a tax bill? That brings us to Section 4, the fuel. And the key, the secret sauce, is incredibly simple. Borrow, don't sell.
The source material is really clear on this. You never, ever sell the golden goose. Why? Because the second you sell an asset that's gone up in value, you trigger a taxable event. You got to pay capital gains taxes. So what do the wealthy do instead? They borrow against their assets. And the reason is simple. The IRS does not consider a loan to be income, so you can pull out hundreds of thousands, even millions of dollars, completely tax-free.
And this creates this incredibly powerful repeating cycle for building wealth. It goes like this. You buy an income-producing asset. Over time, that asset goes up in value. Then you go to the bank and refinance, pulling out that new equity as a tax-free loan. And what do you do with that tax-free cash? You use it to buy another asset. And then you just repeat the cycle over and over again indefinitely. It's a wealth-building machine. And that brings us to our final section, the legacy. Because this whole system, this entire blueprint, it's not just about getting rich yourself. It's designed from the ground up to create a system that can last for generations, long after you're gone.
And maybe the most powerful piece of that legacy plan is a little tax code gem called the step-up-in basis. Here's what it means. Let's say you bought a building for $1 million, and when you pass away, it's worth $10 million. When your kids inherit it, the IRS basically hits a reset button. What does that mean? All those $9 million in capital gains that built up over your lifetime, poof, they're legally erased. Your family gets a completely clean slate tax-wise. It's incredible.
But you know, the source material makes a really important point. The ultimate goal isn't just to pass on money. It's about passing on financial wisdom. A really well-designed trust is more than just a legal document. It's like a set of instructions from you to your future generations. It can encourage education, reward productive work, and pass on your core values. It's how you avoid that old saying about shirt sleeves to shirt sleeves in 3 generations.
So at the end of the day, what's the big takeaway here? It's not about finding some secret, sneaky loophole. It's about financial education. It's about financial literacy. This system, the one we've just walked through from our source material, it's not reserved for some secret club. It's available to anyone who's willing to take the time to learn the rules of the game. Because really, the only tax you can't avoid is the tax on ignorance. Understanding the system is the real path to freedom. So the question I'll leave you with is, are you reading the map?